StreamYard. Yes, we can.
Hey coconuts, welcome back to our weekly market updates with me, Rakesh.
Anthony.
And Jefferson. The new
Awesome,
week.
folks. And
Yes,
it's
Valentine's
been a new
Day.
week.
End of Chinese New Year.
Oh
Yeah, it actually coincided, wasn't it? Yesterday, or was it today? That's the last day of
Today's the last day of Chinese New Year.
Yes, correct.
got
Today's
it,
the last
got
day. So 2 days of
Cool,
celebration.
Hope you guys went somewhere nice yesterday with your partners.
At home.
Okay.
No. We are
Preparing
old
for
and
the
married,
episode.
so we stay at home and watch Netflix.
Hard work, right? Must
Fair
put in
enough.
hard work. Yeah.
Awesome, listeners. Coconuts, we have 3 things for you this week. First is a quick macro update. I understand there's a meeting tomorrow, so Jefferson is going to run through some scenarios in the form of macros. So that'll be really, really cool. Then we have 2 stocks for you. One is Disney, who just had its earnings, and a bit of news in Peloton, right? I think that'll be a fun one to end off with. All right, to kickstart, Jefferson, why don't you take us through what's happening?
Anyone want to take bets on whether it'll be 50 basis points in the coming meeting tomorrow or March meeting?
Whoa.
Yeah. I think that's everyone's plate right now. Yeah.
Are we going to allow bets for a hike tomorrow?
Social
Tomorrow,
gambling.
right?
Ooh, this is not bad. We don't even want money.
Yeah.
I think we should do something stupid if you lose.
Yeah, but I'm at this point in time, I'm not gonna bet on anything. Yeah, I myself think that 50 basis point incoming for March. That's it. Yeah.
For March,
Tomorrow.
I think for March, not tomorrow.
Yeah. Tomorrow, the next few days, the coming week, whatever it is, I don't care. 50 basis point incoming for March. That's it. Yeah.
Wow.
Yeah. Yeah, I think at this stage, right, at this stage, you think about it, is that the Fed delivers a 25 basis point rate hike in March. It's kind of a wet blanket, right? Like you see, everyone's expecting so much more. Like market is pricing 45 basis point already for March, and then you deliver 25 basis point. Hey, what are you trying to like achieve right here? And coupled with the fact that we have already discussed quite extensively as well about how we are already in the new regime. I think hawkish upside risk to the policy rates is needed, not a dovish downside risk. Yeah, I mean, what are your takes, guys?
Wait. So, refresh my memory, right? I think we talked about the possibility of 50 basis point hike.
We did.
Yes.
In March. I think a month ago, not even 3 weeks ago. And at that time, we were like, oh, wait, this is unlikely. I mean, it might be possible, but it's unlikely. Something would have had to happen. So what happened? Is it just the latest CPI that made it, that made the market react or made the Fed react? Or what happened to cause this, I think?
Right. Yeah, good question. I think it's a combination of a couple of things, right? Like last Friday, we see 7.5%. Rather, a few weeks back, we see 7.5% headline CPI, and last week we saw 5%, nearly 5% core PCE inflation, and this is just uncomfortable numbers to everyone in the markets. So the Fed can tell us like wages growth, job growth has been robust and what's not, and how the whole economy is still dealing with pandemic related ebbs and flows very well, with decreasing volatility. I think this is really like smokes and mirror kind of thing where everyone is just concerned, hey, if my everyday goods and services are going to be so much more expensive, what's up, guys? Like, what's the plan? What's the game plan right here? Yeah. And I think like we all see in the news as well, like political crisis, like your whole Ukraine and Russia issues going on as well. Not not very comforting in my opinion.
Yep.
Yeah, not sure about you
No.
guys. Yeah.
No,
But
of
I think
course.
that's uncomfortable on a different level, right? Like
Yeah,
I
exactly.
I
But
don't know if the Fed can affect Ukraine. Probably not.
yeah, but all of which
Although they
is
say
that,
don't fight the Fed.
of course, yeah. I mean, yeah, don't fight the Fed is the key headline we want to bring across as well, right? Yeah. But I think one of the biggest thing to think about is why this whole geopolitical climate is important as well, is because they can't control it. And the only thing they can control is domestic inflation, right? So if you already have so much supply side drivers of inflation, like your chip shortages, your oil price gonna be higher and higher, happy days for all the commodities traders, and all the pot bottlenecks. And if you think about it, like uh, past the Spanish flu, then there was the whole issue of them having to reopen the economy. Then you start seeing like it was still industrialization period back then, but there's a lot of labor skills mismatch as well between every the in the labor force in general. And you also have something which I thought is interesting, and I read it somewhere, which is that the sustained goods demand by companies might cause an entrenched cycle of rising prices as well. Because how the companies then perceive that, hey, the current demand is a lot higher than post pre-pandemic. So should we then continue to produce goods at this level? And with higher demand, we all learn in basic economics 101 is that you're gonna have higher prices as well. And yeah, I think it's all these things are making us, go a little bit cray cray with the whole inflation situation as well. And the Fed, wants to tame tame the tiger in that sense. Yeah.
Cool.
Fair enough, man. I think
Rakesh, anything for you?
with that, I think it's definitely a question, right? So you either increase price with regards to demand, or you definitely you increase supply, right? So you hire more workers, and then you effectively go and make more of those things. A double-edged sword, right? Because if this is this demand sustainable is the other question. Because then if you hire too many workers, it's gonna affect your company's bottom line. All of that could effectively happen as well. So other than effectively, I feel that we don't really know what's happening, and I think the Fed as well doesn't really know whether it's a demand side or supply side, as we talked about even in our previous one. And for me, 50 basis points right off the bat is really scary, though, because they said that they wanted to wait on data. They said they wanted to see what was going to happen. 50, because it's not what usually it's 25 basis points, right? And then see what happens. Then you can go 50. That's the way I would do it.
I mean, they are acting on data.
What data?
Yeah, but they are
CPI.
acting on data. Yeah, CPI,
Right. I mean, I
PCE,
think
inflation.
because the whole point is that they started this loop of, oh, I want to go tighter and I want to raise interest rates, and it works on expectations, right? It's forward looking. So with that, inflation was supposed to have already start falling, right? Or at least start getting under control. But with the latest data point, it shows that rhetoric itself isn't working, right? And that's why maybe more drastic action than what is normally done is required, right? So I don't think we can say that like there has like they have been taking action, because words, well, in a weird sense, the Fed's words are their own actions, right? So since they've already been taking action, and it hasn't been working, I mean, I think that's where we are going, that they just need to take stronger action, and that's where 50 points seems a bit more logical from that perspective.
Yeah, I think so. I think yeah. I guess both of you make some sense, right? Like one is that the Fed is also trying to navigate this whole situation. Two, if you have if COVID didn't exactly happen, they were thinking of keeping rates at where it was. If you read back news pre-COVID, um, so yeah, I did a little bit of digging, right? Then I realized that back then the rate cycle was, they want to keep it. They were thinking of hiking, in fact. So they still debating about it, still in the whole signaling process and what's not. Um, and then COVID happened. They had to lower rates a lot more, and now this whole thing with post COVID and what's not. I don't even know whether you can call it post COVID, to be honest, or maybe just a phase where we are navigating
Yeah.
as well. Um, yeah, I think don't go. I mean, just don't go crazy and think that every meeting, if the Fed during March, come out and say, hey, we just gonna do a 50 basis point in March, and don't just take it like it's just it's probably just gonna be a one-off thing. It won't probably happen every other meeting. Yeah, if it happens, then I think there goes all the housing loans. We can forget about buying a house. I can forget about buying a
Yeah.
house. Yeah,
That's
You
my
wanna
worry
yeah,
as well, right?
yeah.
Because like 50 basis
Um,
points, what happens if it's too drastic, right? That's definitely a question that it's on my mind. But of course, right there's the other aspect of things, which is what Anthony is saying, is that what happens if 25 basis points isn't drastic?
yeah, I mean
Um,
that itself, if 25 basis point isn't a very drastic number itself, right? Then people are just going to be uh just have to suck it up and be like, oh yeah, it's a sore disappointment for the time being, and potentially we're going to see like some emergency rate hike that happens in between the year and what's not. And given the whole FOMC speakers list that they have been talking in the past week as well, pre the 16th February meeting, then you can see that yeah, they're coming to realize that, hey, maybe it's a good idea to do some form of 50 basis point hike as well. So that can be something that they are warming up to in some sense.
mm,
But I think something to just a food for thought, right, is that 50 basis point is definitely not normal.
Mm.
And if you
yeah.
look back in history, they did actually start a hiking cycle with 50 basis point back in the 1980s as well. So that wasn't normal times, and we are not in normal times as well. So I think it's just
Yes, yes.
a
When a
different.
transitionary period, right?
Yeah, that's what they have been saying, right? Yeah, yeah. It just means uncertain times, guys.
Yes.
Yes.
Yeah.
Be
But
fair.
I think a very interesting thing. Moving on from this whole 50 basis point thing, I think uh, it's it's more important to look ahead, right? And there's three rate hike scenarios that I think will be interesting to look out
Mm.
for.
Okay.
One
Mm,
is that if in 2022 they decided to do a 125 basis point rate hike, which is what everyone is pricing in the market as well, and this still comes with say core PCE falling below 3% by year end. Happy days for all of us, I think, in that sense. And why I say that is really, if you look from that perspective itself, it's the best of all worlds, right? Where you have you need commodity and shipping costs to peak in quarter one of 2022, which is what they are all saying right now. Yeah, it will
Mm.
blow away everything. This is just transitory, and this all will essentially pave way for lower inflation. And you need the growth to remain strong, unemployment to fall as well, to say
mm,
below 3 to
Yep.
3.5%, with the participation labor force to rise to pre-pandemic levels as well. So essentially, you're gonna get a healthier economy in that sense, and it will
Yes.
definitely reflect in your company's earnings, and asset prices will remain well supported in this scenario that I propose. But
Mm.
I think there's still, it is more of a, like, I wouldn't say that it's a dream or anything like that. Maybe like I would say attribute about like 40 to 30% probability that
Okay.
this will happen. But maybe something slightly more challenging in that sense will be under the rate hike, and how it has proven to be a signaling effect in the past, right? Right now,
Mm,
them having to do it,
Mm.
it come a little bit too late in that sense. So what
mm,
happened when it's a little too late is that you don't see much changes in terms of the labor participation force. You don't see
yep,
much changes in wages and price dynamics as well. Everything stays status quo. You still see inflation high, and what's not. Then what the Fed will do is that you come out and say, hey, we're gonna reevaluate and potentially prolong the strings of hike again.
okay,
Then it will
Right.
be a drag on asset prices.
yep.
Not great for us. Rate portfolio again.
It's
Yeah,
okay. What does
yeah,
it kill
exactly.
makes you
Used to
stronger.
it already. Used to it already.
Yeah.
Just do it already. I
Um,
just don't look. It's fine.
and then maybe 2023 will be a much better year for all of us. Yeah. But I think it's hard to separate the probability of this scenario from
Mm,
the first one, right?
Mm.
Then
Yes.
the last one I can actually think about is that, you know, you have inflation still overshooting, even though you have all these strings of rate hikes. You have a sharp growth slowdown and what's not, and maybe even a asset price crash. Then, in this scenario, what has to happen is basically you need energy, shipping prices, commodity prices to still be uh, rising sharper and sharper.
yep.
Then you start seeing, even though maybe you see like wage growth acceleration as well, which then fuel for price dynamics to go even higher, inflations to go even higher in that sense. And with the whole Fed hikes is no longer effective anymore. So you
Mm,
want to push down investments, you want to push down consumer spending. Yes, it's all going to happen, but with that, spending, because you have consumer spending becoming lower, investment being lower, your GDP take a hit as well. Then
mm,
eventually there going to be a sharp correction in your asset prices. But I think this last scenario is unlikely in that sense. Um, it won't be as severe because the Fed probably want to prevent this from happening as well.
yep.
So which is why the messaging from Powell has been a lot more gradual in that sense when it comes to rate hike. Yeah.
Yep. Yeah,
Got
I
it.
mean, I
So
think that the last one
Yeah.
is the painful one, right? Because we there's always this scenario in my mind where they keep focusing on inflation so much, and they keep raising interest rates to combat inflation without really taking into account the time lag, right? Because there's always a lag
mm,
between raising interest rates and seeing its effect on its economy. Then what happens is they raise it too hard and too fast, and we end up in a recession for whatever reason, right? Because
Mhm.
economic growth isn't as strong as we thought it was, and maybe we see some
yeah.
signs of it in PMI being not great now and all of that. And then boom, we end up in, we did not fight off inflation too well, but we got a recession. So I guess that's where we end up, which also isn't great.
Mm.
Yeah, I think so, right? So the first, for me, the two all makes a bit more sense, or probability, right? The only question here is it going to be
Mhm.
nice and easy? They raise it, then it comes down just like your economic books, and or is it going to be a roller coaster ride
No.
for the next 6 months to a year, as they figure out actually how does the market work, right? And I really think it's the latter, or scenario two. That's the way that I think I see that. So I'm prepared for my portfolio to be in red for a little bit more, and just try and hope for all of these things.
Mm.
Yeah.
Yeah,
Actually,
for sure.
on
I
that,
I think it's Mhm.
sorry, Jeff, I wanted to ask you, right? So it seems as if
Yes.
we are just going to go through a lot of volatility. It'll be some up, some down, some up, some down, right? Because expectations change and all of that. How, you know, is there a way to position it properly, or is it just, oh yeah, take profit and run, be a bit more nimble, don't think so much long term, try to do a bit of market timing, which I feel fundamentally quite uncomfortable with, or is there some other way that you would see people play it?
I think in the space like this, right? One of the things I'll look for is I wouldn't look at all your growth stocks or whatever, your value stocks and what's not. But I like to look into the space where you can see maybe REITs as well, potentially because of some form of interest rate uh, risk mispricing, right? Then
Mhm.
you can buy into it and maybe just hold for it very short term and then sell it off.
Hmm.
Or some other stuff that I like to look at is commodities. Yeah, I think we discussed it in one of the episodes as well. Commodities ETFs. I think that is a space that we can look at. Or lastly, then maybe you can start look we can look into, say, the emerging markets as well, like Vietnam. Those give good space where you can, pick some opportunities as well and buy into it, because their central bank, they are not going to position themselves to do a rate hike as quickly as all the other developed markets as well. So it's more of a wait and see, where you still have a little bit of room to play, and see how then in the developed markets it plays out before it plays out in the EM space as well. So these are the few space
Got
that
it.
I'll position my
So,
portfolio.
so China.
Yeah, in other words.
Um, I mean, China is different. China is very different. I think
Australia also lah.
we
Australia
discussed
also.
as well. Yeah. I mean, China is a different ball game, right? I mean, Australia is good because it's a lot driven by
Yeah,
commodities, right? So,
commodity.
Hmm.
you're probably gonna see some upside in that markets as well. Yeah.
Yeah, I think just as a quick digress, I'm taking a look at lithium, and that's been skyrocketing in the ASX as well. So good to just keep note of all these things.
Yeah. It's just a very different play that we are all navigating. No longer the
Mm.
buy anything, throw a stone into the US equity markets, and you get X% return. Yeah.
Yeah, man. I
Yeah,
what
it's a very
2020,
different,
you
very
touch
different.
literally any stock it was like Midas's touch. You made money, right? So
Yeah. Yeah.
awesome, folks. All
The
right.
GCB
Thanks so much
dreams
for
getting
that.
further and further.
Yeah, I think everybody's GCB dreams is quite far away, lah.
It's okay.
Uh, all right, folks. Thanks so much, Jeff, for the quick macro update. Well, not really quick, but for the good macro update. I thought it was a
Somehow.
really nice thing to go through the scenarios, right? I think that's quite interesting, and we look forward to tomorrow's meeting. All right, let's move on to the next one. Anthony, Disney. What happened there?
Yes, Disney. Oh, Disney just announced earnings, right? So, I think Disney is a company that people are definitely familiar with, because you can't really touch anything without touching Disney now. But yeah, they had
Yes.
earnings last week. They did it decently, I think I would say, and they are obviously not a growth stock, or at least not as growthy anymore. So no 20% up,
Mm,
20% down after earnings. So it was a mere 3%. So that's not too bad. But I think they are 3% up, beating earnings. So I think, in times of volatility like this, besides whatever Jeff has mentioned, it might also be useful to look at the big stabilizing companies, the things that are rooted in the real world, right? Not just crypto and tech, because then you at the very least, if the economy does improve and all that, then these companies also follow along. So I was looking at Disney, and well, yeah, maybe just so actually before we go into numbers, when we talk about Disney now, which part are you guys interested in? Is it just Disney Plus because we all subscribe and we want to watch TV?
No, for me it's a mix. For me, it's the parks. I do want to know a bit more about their parks, given that everybody's sort of easing into it, and I know that they make some money out of that as well. Disney Plus for me is a small part of the revenue, I feel, but please correct me if I'm
Mhm.
wrong. But it's growing. It's growing quite a bit, and I think that's the area that they're trying to focus on.
Yeah, and I think that's almost exactly on point, right? So you're exactly
Oh
right.
wow,
Disney
cool.
Plus is slow. Well, it's growing. It's not growing super quickly. It's still way behind Netflix, right?
Mm,
But I think it's they're trying, they're focusing on that, so that's great, and we can talk more about that later. I think what was really impressive this time round was their parks results. So in 2021, oh sorry, just the past quarter, they
Yeah.
it was actually their highest ever revenue and operating income for the US parks, right? So don't care
Whoa. Even
pre-COVID,
including like
post-COVID, whatever.
ever.
Yeah,
Yeah. So
ever.
ever. So in their
Okay, how
life.
does it even work? Yeah.
That's
And
right, right?
park entrance lah. Park
Yeah,
No,
entrance,
I
whatever
mean,
they spend
I
in the
mean,
park.
like, it's COVID, right? Like, do you
yeah, no,
expect
which is what's
anybody to be
amazing
going?
about it.
Yeah.
So it's restricted. But I mean, US is mostly open now, but they still have
Yeah,
restricted
that's what I thought.
capacity, right? And
Ah, okay.
and despite that, they still had the highest ever revenue, and a lot of it was driven by operating margin. So I
Mm.
think in the COVID times, they when they were all closed, they did a lot of works around trying to monetize when they could reopen. So they had like new apps, so they push people to spend more, and that's just they became
Wow.
more efficient, and that's just how they achieved the top revenue even with capacity constraints. Yeah,
Wow.
so I was like,
Awesome,
oh,
folks.
that's actually impressive, right?
Yeah, totally. It's effectively like a springboard approach, right? So they sort of contract the spring during COVID, like sort of just consolidate, make everything efficient, and then as soon as it opens up, it just spring forward again in terms of rev and all of that. So I think that's really really cool.
Yeah. Yep, and I mean, if you think about it, yes, US is open, but Tokyo, Hong Kong, China, where there's Disneyland everywhere, it's still mainly closed because of zero COVID, because of COVID generally. So if they can
Mm.
translate this, across when we reopen, whenever that is, whether that's this year, 2023, 2024, there is going to be quite a lot coming through to their bottom line, right? Or even if the US fully reopens and there's no more capacity constraints, there is room to grow even from this record revenue level. So I think parks is it's not only been a great business, it's actually becoming a better business as they move past
Wow.
COVID.
True. True. What about like?
Yeah. Sorry, Jefferson, you guys.
Jeff, sorry, were you saying something?
Oh, right. Yeah. So I was just wondering, like, what about that? One of the big production is Marvel, right? Their
Yeah.
linear networks, their content sales, licensing, like this must have account for something. I would assume. I reckon it's an interesting time for them with COVID and how they position their movies.
Mm.
Yeah.
Yeah, I think movies actually haven't done well. Well, quite obviously, but yes. So the box office tickets haven't been great. I think licensing is been quite steady, right? So
Mhm.
they don't do licensing because it goes to third parties, it's toys, it's all that. They don't actually change that much year to year. They change it from having greater IP more than trying to extract more from whatever they have. So you know licensing is okay, but movies have just been terrible because of box office globally, and we have talked about this before in previous episodes as well. Partially that's also been a push to streaming, right? So they do same day
Mm.
releases to and maybe cannibalize a bit of the maybe cannibalize a bit of their box office, or they don't even do box office like Encanto, and it became like the top hit in Disney Plus in the US like overnight. I think it was like 200 million plus views or something. It's insane.
Wow. But question, right? Reading this thing that Spider-Man, Far is like really, really close to like the top earner in terms of movies, right? So I know that that's a split with Sony there, but do you know whether
Mhm.
it's Disney gets some cut from that?
I don't know actually. I mean that my first reaction is Spider-Man is top grossing, but that should only be top grossing among 2021, not top grossing like ever.
They were
Is that
comparing it
right?
to Avatar, actually. So
Oh,
actually, I think it's almost ever. Yeah, I think it's just below Infinity War,
Oh
in terms
wow.
of grossing.
oh,
It's apparently it's insane. Like I was reading news articles where people were forgetting, like, they don't care about COVID, they're just going to go see Spider-Man. And unfortunately, I was one of them, right? So,
I mean, it's a nice movie, but I don't know if it deserves to be like top grossing ever.
okay, well, I have to tell you that I teared. I did tear, man. That was awesome. Like, I loved it.
Cool.
Yeah.
Yeah, I don't know. Oh wait, it's 800 million. Okay, that's decent, right? It's not it's good, but it's not near Avengers or something like that.
Yeah, I think Endgame was quite high, 3B or something, right? Was it? I'm not sure.
Yes. Oh no, sorry. Yeah, I'm just googling this now. Spider-Man was the sixth highest grossing movie ever.
Yeah, you see? In
Yeah,
COVID times, that's
but it
insane.
did not even it didn't even make their earnings report. Maybe because it's not in the same reporting period. I'm sorry.
Yeah, maybe. Or
Yes.
actually because that money is split with Sony. So therefore, in the books, it didn't make a dent.
Yeah, I
Oh
mean,
yeah,
800 mil
probably.
it probably doesn't make a dent anyway, right?
Yeah.
You need like the revenue is just insane.
True. Doing what else popped up? Because I mean,
Yep.
you mentioned Disney Plus is not going to streaming, but they bought like sports channels and all that, right?
No, so Disney, yeah, sorry. So Disney always had ESPN. In the US, no,
Okay.
not they always own ESPN. It's just that we don't get to see much of it in Singapore. So that's always been a part of their stable. And I think they are pushing slightly strongly into sports streaming. So they're trying to bid for rights. They're trying to beef up the ability of what they can show. But again, it's very US centric. So it's NFL rights and all of that. It's not EPL, unfortunately. It's not really
Got it.
cricket. So we shall see.
Yeah. Caught it, man. And so what's our takeaway for this Disney quarterly earnings report? What do you think? Should this a buy? What are your thoughts here?
I don't know. I mean, I just keep looking at Disney. I have my one share from Mumu. Yeah, no, from Tiger. I got that one free share like a few months back, and I've just never sold it. So I just seen it go up and down. I think it's an interesting business model, right? So you can see their pre-COVID business starting to do well. They obviously have a formula down pat for their box office. Licensing is going strong. And the kicker is streaming, right? And streaming to me seems to have two different aspects of it. One is it could be revenue generating like Netflix, right? Or of course, when we talk about Netflix, we are worried about unit economics and all that. So that could
Yep.
also play in here. But the other thing is Disney is much broader than Netflix, right? So whatever you manage to stream, you manage to grow new IP on Disney Plus or Hulu, you can build it into your licensing. You can make a movie out of it. You can build an immersive experience in a theme park, which brings you back to your streaming and new series and all that. So you can see their flywheel beginning to spin quite quickly, right? And I think that's what's interesting to me about the business. That the parts work together. They are quite coherent and they can feed into each other's growth. And then of course you have sports and maybe sports gambling and all that, which is a new growth area. So yeah, I think it's interesting to look at. I have no idea about valuation. I think sometimes people think about it as tech because of streaming. Sometimes people think about it as a traditional business. So it'll go up and down. Yeah, it might just be something you accumulate to a decent size and you can hold for 3 or 5 years as something in a portfolio to stabilize it.
Got it. Jeff, what do we think?
Yeah, I mean, one of the things that Anthony mentioned was the whole subscription video on demand penetration, right? I don't doubt that if they have a lower than expected penetration on that front versus say Netflix, Hulu, and what's not, whatever, right? This just posed to be downside risk as well. And I think also with how the rising sports costs, like you get videos or you get rights to show sports on your own subscription channel and what's not. It's all rising at the same time with greater than expected competition as well. All of which will prove to be a downside. But for now, I think they are still doing fine on the front where they are still upgrading parks, trying to come up with new teams and what's not, which come to me as very big surprise, during COVID.
Yeah, you don't think about it that way, right? You think,
Yeah.
park means power.
Yeah, but I guess they turn a crisis into opportunity. So kudos to them for that. And definitely, with a lot more movies coming up in I think in 2023, you have like quite a few Marvel movies like I think Moon Knight, then Star Wars. You have like Obi-Wan Kenobi coming out as well. Yeah, all
Yes.
of which will get people excited and coming on board. So I see it to be quite favorable in that sense where we can position ourselves to have it one or two in our portfolio as well. Yeah.
Got it. Cool. I do think it's quite diversified. So I do see some growth there, but it could be, just keep your money there. I don't think it's going to grow by much. Like you mentioned, Anthony, but 3% increase, even though they beat expected, right? So
Yeah, but that's fine. Slow and steady wins the race, right? We get rich slow.
exactly.
Yeah.
Exactly. And this time, I think
well,
it's
Mickey
fine.
Mouse.
Yeah.
Yeah.
It's
Well,
scary,
Mickey Mouse
scary.
have seen more crises than all of us combined. So
Yeah.
Mickey Mouse could be older than all of us combined, actually.
exactly.
I think it is.
He knows.
Yes.
Yeah. He knows what's going on. Yeah. Yeah. Have some faith in them. Yeah.
House of Mouse. All right.
Yeah.
Awesome, folks. Thanks so much for that, Anthony. And I think lastly, just very quickly, I want to touch on Peloton. So I think one of the things why I wanted to talk a bit about Peloton is because we talked about it 3-4 weeks ago during its earnings call. We talked about the leaked memo that came through from an employee, somehow got leaked. And there was, at that point in time, there was an activist investor trying to get the CEO out of their seat. And it turns out that he is out of his seat, right? On February 8th, he actually vacated and resigned. And a CFO, ex-Spotify CFO, has taken over as CEO of Peloton. And the first thing he said was, we are here to restructure and make sure that this company is good. Its financials are sturdy and build its foundations again.
So I guess that's
now,
what a CFO has to say, right?
Of course. Now, I mean, just from
he
my
doesn't know like anything else.
In all fairness, CEO said the same thing, right, during earnings call. So I mean,
yeah, but I mean, the CEO, can sell the vision. This is my dream. This is my ambition. The CFO just goes, no, guys, numbers, and the COO goes, no, supply chain. Right? They have their specialties, and I guess that's a sign of where the company is going.
Absolutely right, and I mean, testament to what Anthony just said as well. Usually when a CFO jumps into the CEO, at least in my experience, is that it's not really a good sign for the business because now they're just really going to cost cut and just make sure that the bottom line is back to normal, right? And on that note, they did state that Peloton will lay off 20% of its workers, right? Straight up. So that's 2,800 that are going to be laid off, which is insane. They're also pausing bike production because they made too many bikes for the slowing demand, and they just kept going and going and going. Actually, that rumor about the leaked messaging kind of was true.
Yeah, I mean, they
Sorry, Jeff, you're saying something.
Quite a lot.
Can we not forget that they all get free all access membership as well for getting fired? Just for 1 year.
Oh,
yeah.
right. Wow, nice.
Yeah.
Actually, I want to talk about that all access membership, which is awesome, right? And believe it or not, on Feb 7th, there was rumor about a buyout of Peloton, and the stock rose 21%. On Feb 8th, when the CEO resigned, the stock rose 25%. So we live in volatile times, folks.
You need more people on the strategic committee to be leaving.
Yeah.
In Peloton case, yeah.
Definitely. And I think that's something I want to talk about, right? The more about it, or the market sentiment, there could be a buyout, right? And if you read the news now and then, there could be. And one of the reasons why I feel that it's also actually, there's some truth to that rumor, or there's truth to the market sentiment, is because they have a really good subscription service, Peloton, right? We know that they started with this on top of buying the bikes that cost what 1,008, etc., you have to pay $39 a month for its subscription, and it comes with training and so on and so forth. Now, some numbers for you here. They have roughly 6.6 million members on that system. Whether they pay, I could not check whether they paid $39 or the digital subscription without the bike, which is I think $12.99. But what I do have from their investor page is that they have a 92% retention rate of these subscribers. That's insane. That's amazing numbers. That's where their revenue driver is. That's what they're great at, right? And if you think about it, on top of that, in their Q4, their subscription revenue was actually up 132% to 281 million. And their digital subscriptions were up 176%. That's 874,000 people on digital subscription. Now, that's amazing, right? That's where their money is.
Wow.
And now if you start looking and just start thinking around about this rumor, there is some substance, because there's a few companies out there that are looking to grow their fitness side of things. And one of the big ones that I have to say is Apple, right? Because in our last earnings call, they talk about how they're going to focus on Fitness Plus and try and grow that. And they just started Fitness Plus. And if you look at their retention rate, it's almost, in my opinion, reeks Apple, right? It keeps you within the system. It keeps the clicks. You're going to get the people. You're going to combine it with your all-in-one membership with all the other stuff that they have. And you're growing the Fitness Plus. So this could effectively mean buying more watches and everything else, right? What do we think about that?
No, I mean, you make a fair point on that front, but it's all about having to integrate into the ecosystem, right? And I'm not sure whether, like, you know how Apple likes to come up with their own products in that sense.
True.
For that advantage, it might be more in their favor to just build it out just for the whole ecosystem, for the branding and what's not, than having to use Peloton equipments and what's not altogether. Yeah, that's just one of the things that I can think of. But I do think like other sports brands like Nike, Adidas could come on board to do some form of partnership with them to leverage upon the subscription the subscription base that they already have, to roll up some of the newer training videos and programs that they are trying to roll out as well. I don't see why not.
I mean, I think at the peak of its hype, Peloton was the Apple of connected fitness, right? So maybe that's where the Apple because they have the good branding. It's expensive and pretty, but people go, why is it so expensive? Which is Apple to me. So I see where that comes from.
Exactly.
But I think then Apple Fitness is slightly different, because they don't actually come in on the hard. I mean, they have Apple Watches and all that, but it's all meant to be monitoring and tracking. It's not meant to actually push you that hard into fitness, right? So and for Apple to go into that, just seems to be slightly out of character for them in that sense. So I mean, I agree. I don't think Apple is probably the most suited buyer, at least from Apple's own perspective. Nike is interesting, right? Because these people have always wanted to do connected fitness. They have their running app. They did something during COVID. I don't know what. I downloaded it, never opened it, because I wanted to post Slack and next. So they do have things, and Nike is clear, right? Because their competitor Lululemon did almost exactly the same thing, right? It was Lululemon. They had their Pro. They bought Mirror, right? Which is weights, more weights than like bike, but that's essentially the playbook. Maybe that's what Nike is following. But I think this whole volatility thing has been so interesting, right? Because all your super hyped up, super expensive stocks are now cheap enough to be buyout targets. Right? And that's the fun part of it. What's next? Maybe next time C will get acquired by Amazon. or Alibaba.
Wow.
Maybe not Alibaba. But yeah, Amazon is good. So maybe Nike, maybe Amazon could buy Peloton.
Hey,
Amazon
but
wants to know that.
you never know that maybe you will have Disney having to buy Peloton. Yeah,
Yeah,
it was
is it?
it was no, I mean it
They
was
were,
in
right?
talks before. Yeah, they were in talks
Yeah.
before. I
Wow.
think sometime last year they were talking about it. And in fact, if you just look, just do a very quick Google like Peloton Disney classes, you can find a whole list of it as well. Um, Disney rides and what's not for kids, and yeah, so
Yeah.
I think it might be a fairly good deal in that sense where you can bring two of the brands with loyal customer base together, and there might be a lot of potential benefits from this acquisition as well.
True. Imagine putting
Yeah.
Disney
So I
Plus
think
in all of
core of
those
it is that
screens.
Peloton has a great product, right? Yeah.
Yeah,
Yes, Peloton does have a good product, right? And you can clearly see with their retention rates, it's actually decent. That's their revenue driver, right? If they get if
yeah,
Yeah,
they get certain
but
things
that's
fixed,
what's making them attractive for a buyout.
absolutely, absolutely. So
yeah,
we are in agreement here that there could be a buyout. There could be companies looking at them.
Yes.
yep.
Yes.
I think
I
that
think
is possible. Yeah.
that the only problem is that the Peloton CEO came out, I think today or yesterday, and said, nope, sorry, we're not going to sell.
Yes,
Mm.
he did say that. But I mean,
Unfortunate.
let's see. Let's see. He never knows.
Actually, now that I think about it, right, if Disney ever buy uh Peloton, it'd be great
Mm.
on the marketing synergy front, because think about it is that they have ESPN, ESPN Sports Centers, offering breaking news, highlights and what's not. You can just place Peloton advertisements to just attract customer. That's just a strategic move, right? It's totally in their favor. Yeah, I would do that.
Absolutely.
Yeah.
If you were CEO of Disney, is it?
Yes. If you were
Peloton,
CEO of
don't
Disney,
ask for
you would
Disney.
do it.
Yeah.
Nice. I guess then the last question is, right, if there is stake for buyouts on Peloton, should we buy Peloton? What to our coconuts and what's the it's effectively a bit of a risk here, but do you think we should buy Peloton? Anthony, go first.
This is a gamble, right? It's straight out gambling. You can't control it. You can't have any foreseeable news about it. All you can know is it's a good product. Therefore it's a good product. It's maybe relatively cheap now. That there's clear operational issues that an acquirer can solve. So therefore it may make a good target. But to put money in and to tie money in, and it could still go down, right? It's still a
Mm.
growth stock and treated as trash. So it could still go down, and you are just hoping that
Treated as
it
trash.
goes up. It's a gamble. It's straight out a gamble. I don't see who can say that, oh yeah, I can play the odds on this and win. I mean, if you can, good for you. Please tell me what odds you're playing.
Mm.
Jeff, what do you think?
And then now Jeff will tell me the
Um,
odds.
The odds, yeah.
Well, I wouldn't even talk about having to like whether to buy when they do a merger or what's not, right? Like even right now, I think that there's there's way too much risk going on with regards to their whole strategic committee. They really need to sort that out, make it clean on the management front. The second thing is really the whole industry that they are in is so dynamic, it's so competitive. Like it's becoming a place where it's becoming more and more cutthroat in that sense, right? And you can't even sort your own management issues properly, then what's going to happen? The programs that you come out with is just garbage in, garbage out in that sense. And
Yeah.
you need to look at the whole broader macro slowdown as well, where it potentially might impact consumer spending power. Well, the bikes are not cheap as well. I was looking at
Yeah, it is.
eBay, Amazon the other day. People were reselling their bikes, and in fact, if you do a quick search, there's more and more people selling their bikes. Yeah, why is that so? I don't know. I don't have an answer, but my guess is that people need the cash for something else. Yeah, because they think that fitness is not something that you can get
Because
fitness
kena
cheap as
margin
well.
call.
Elsewhere.
Opiate.
Yeah, maybe, yeah. So so they need to come up with more innovative means to strengthen their whole business model. I would think. Yeah, for me it's a no. Yeah, I wouldn't go for it.
Got it.
Yeah.
Got it. All right. Thanks, folks. Thanks for tuning in today. I think just signing off, and we're happy to see you next week. Hope you learned a thing or two. Bye.
All right, see you guys.
Bye
Bye.
bye.